Look at the Shanghai-London silver spread right now. As of late January 2026, Shanghai futures are trading at $130 per ounce. Western futures, $104. That's a $26 premium, 24% higher in China than in London. This is not a price anomaly, this is a physical liquidity trap. While Western paper markets show silver at manageable levels, the physical reality in Shanghai tells a different story. Chinese industrial users are paying massive premiums because the metal is there and it's staying there. Western manufacturers who need silver for solar panels, semiconductors, and defense systems are being priced out of the market they used to dominate. Here's what that means for the sovereign ratio. China has created a one-way valve. Silver flows into Shanghai, it doesn't flow back out, and the gap between paper prices in New York and physical prices in China is the clearest signal we have that the Western pricing mechanism is broken. Let me show you exactly how this trap works and what it means for your allocation strategy. Let's start with the mechanism that's creating this vacuum. Shanghai futures are at $130. Western futures are at $104. That's a $26 spread. In any rational market, arbitrageurs would immediately buy silver in London, ship it to Shanghai, and pocket the difference. The spread would collapse within days, but it's not collapsing. It's widening. Here's why. China's 13% VAT trap. When you withdraw physical silver from Shanghai Gold Exchange warehouses, you pay a 13% value-added tax. That adds roughly $15 to $17 per ounce to your cost basis. So the actual cost to take possession of Shanghai silver isn't $130. It's closer to $147 once you factor in the tax and withdrawal logistics. Now look at the other side. If you import silver into China, you avoid that VAT because you're bringing in metal from outside the system. The 9% import advantage exists on paper. You're buying at $104 in London, adding shipping and insurance, and landing the metal in Shanghai at maybe $110 to $115. That's still cheaper than the $147 you'd pay to withdraw from the exchange. So why isn't this arbitrage happening at scale? Because once silver enters the Shanghai Gold Exchange, it dematerializes from Western ledgers. The metal gets recast into Chinese kilobars. The American Eagle stamps get melted down. The history gets erased. That silver can never be rehypothecated to back a paper contract in New York. It's gone from the Western system permanently. Look at the trading volumes. Shanghai processes roughly 100 million ounces per day in futures contracts. London clears 200 to 300 million ounces daily. But here's the critical detail. London clearing volumes represent paper shuffling. Shanghai's premium reflects actual physical demand. The one-way flow is structural, not temporary. China now controls 60 to 70% of global refined silver supply. On January 1st, 2026, Beijing implemented export licensing that requires an 80-ton annual production minimum and a $30 million credit line. Only 44 companies made the approved exporter list. Hundreds of small and mid-sized firms that used to supply the West were cut out entirely. This isn't a supply chain disruption. This is a deliberate reallocation of industrial capacity. Now connect this to solar demand. China added 315 gigawatts of solar capacity in 2025. That's 20% of global silver consumption locked into photovoltaic manufacturing. High-efficiency TOPCon and HJT solar cells require more silver per watt, not less. The substitution efforts failed, copper doesn't work, aluminum doesn't work, silver is irreplaceable in semiconductor bonding and photovoltaic paste. So China is consuming the metal domestically while simultaneously restricting exports. The result is a liquidity trap. Western industrial users who need silver for defense manufacturing, F-35 guidance systems, Tomahawk missiles, satellite contacts, are competing for a shrinking pool of available metal. The COMEX registered silver inventory has been decimated. We're operating on statistically irrelevant stockpiles. The buffer is gone, the tank is empty, and the needle is on zero. This is why the $26 premium isn't closing. It's not an arbitrage opportunity. It's a routing signal. The market is telling you where the metal is going, and it's not coming back. This price gap didn't appear overnight. It's the result of a deliberate policy shift that began on January 1st, 2026. Let me walk you through the mechanics of China's export control framework. The licensing system replaced the old quota model. Under the new rules, any company that wants to export refined silver from China must meet two requirements: an 80-ton annual production minimum and a $30 million credit line. That's not a suggestion. That's the barrier to entry. Only 44 companies made the approved list. Think about what that means. China had hundreds of small and mid-sized silver refiners and traders who used to supply international markets. They're now locked out. The government consolidated control over 60 to 70% of global refined silver supply and handed it to a small group of state-approved exporters. This is the rare earth playbook applied to silver. Same strategy, different metal, same geopolitical leverage. In the 2010s, China controlled 97% of global rare earth production. They used export quotas and licensing to squeeze supply, drive up prices, and force Western manufacturers to relocate production to China if they wanted guaranteed access. It worked. The West lost its domestic rare earth processing capacity and became dependent on Chinese supply chains. Now they're doing it with silver. Look at the timing. China controls solar manufacturing. They added 315 gigawatts of solar capacity in 2025. They dominate photovoltaic cell production, and now they control the silver those panels require. This isn't about trade policy. This is about locking in the raw materials for the industries China plans to dominate for the next 30 years. Western manufacturers are facing a 12 to 24-month timeline to diversify sourcing. That's how long it takes to qualify new suppliers, test alternative materials, and reconfigure supply chains. But there are no alternative materials. Silver is irreplaceable in high-efficiency solar cells. It's irreplaceable in semiconductor bonding. It's irreplaceable in military electronics. So the West is stuck. They can't substitute, they can't wait, and they can't access Chinese supply without Beijing's approval. Here's the strategic calculus. China is treating silver like ammunition reserves, not a tradable commodity. They're not trying to maximize export revenue. They're trying to secure industrial capacity. When you control the inputs, you control the outputs. When you control the outputs, you control the markets. And when you control the markets, you control the geopolitical leverage. The U.S. Department of Defense doesn't have a strategic silver stockpile. We sold it decades ago to suppress prices. Now, when Lockheed Martin needs silver to build missile guidance systems, they have to compete on the open market with Chinese solar manufacturers and Indian jewelry buyers. That's not a supply chain issue. That's a national security emergency. China refined $3.8 billion worth of silver for export in 2024. That was before the licensing framework took effect. The 2026 numbers will be dramatically lower because the policy is designed to restrict flow, not facilitate it. And here's the part that should concern you. Beijing can tighten this further at any time. If geopolitical tensions escalate, they can reduce the approved exporter list from 44 companies to 20. They can raise the production minimum from 80 tons to 150 tons. They can add new credit requirements or environmental compliance standards that only state-owned enterprises can meet. The framework is flexible. The control is absolute. And the West is now realizing what happens when you outsource both manufacturing and the raw materials that make it possible. Now let's talk about what happens when climate policy collides with resource scarcity. The West has committed to aggressive decarbonization targets. The European Union wants carbon neutrality by 2050. The United States is pushing massive solar build-out under the Inflation Reduction Act. Every developed economy has some version of a green energy mandate. Here's the problem. You can't build solar panels without silver. High-efficiency photovoltaic cells use silver paste as the primary conductor. It's the material that collects electrical current from the solar cell and routes it to the circuit. For years, the industry tried to reduce silver content per watt. They experimented with copper. They tested aluminum. They tried thinner metallization layers. Physics fought back. The new generation of solar cells, TOPCon and heterojunction technologies, require more silver per watt, not less. These cells achieve higher efficiency ratings, which is what the market demands. But higher efficiency means more complex metallization patterns, more silver paste, more conductive surface area, so the substitution narrative collapsed. There is no viable replacement for silver in photovoltaic manufacturing. The industry is locked in. Now look at the demand explosion. In 2025, global solar installations added 434 gigawatts of wind and solar capacity. Solar accounted for 315 gigawatts of that total. That's roughly 20% of annual global silver consumption absorbed by one industry. The 2026 projections show a slowdown to 341 gigawatts of solar deployment. That's still a massive number. That's still 20% of the silver supply going into panels that will be installed on rooftops and solar farms from California to Germany to India. But here's the trap. China controls the manufacturing. Chinese firms dominate photovoltaic cell production. They control the supply chains for polysilicon, wafers, cells, and modules. When Western countries buy solar panels to meet their climate targets, they're buying Chinese products that consumed Chinese-controlled silver. The West set climate policy without checking the periodic table. They mandated solar build-out without securing the raw materials. And now they're dependent on a geopolitical rival for the inputs required to meet their own policy goals. This creates a strategic dilemma. If you're a Western government trying to hit decarbonization targets, you need solar panels. If you need solar panels, you need silver. If you need silver, you're competing with Chinese industrial users who have preferential access to domestic supply. The math doesn't work. The supply doesn't exist. And the prices are going to reflect that reality. Let's talk about defense manufacturing for a moment. Silver isn't just in solar panels. It's in every piece of modern military hardware. F-35 fighter jets use silver in avionics and guidance systems. Tomahawk cruise missiles require silver for circuit boards and targeting electronics. Satellite communications depend on silver contacts that don't corrode in space. The U.S. defense industrial base doesn't have a strategic silver reserve. When Raytheon or Northrop Grumman needs silver, they source it from commodity markets. They're competing with Tesla, Samsung, and Chinese solar manufacturers for the same finite supply. That's the green energy trap. Climate policy created industrial demand that the supply base can't support, and the country that controls the supply is using it as geopolitical leverage. The LBMA SGE disconnect is telling you this in real time. London prices reflect paper market dynamics. Shanghai prices reflect physical scarcity in the world's largest consuming region. The 26 premium is the market's way of saying that Western price discovery is broken. Now let's talk about what this means for your allocation strategy. The two-price reality between Shanghai and Western markets is a routing signal. It's telling you where physical metal holds value and where paper contracts are disconnected from supply. The LBMA daily fix no longer reflects physical availability in major consuming regions. London prices represent legacy pricing mechanisms built for a world where Western vaults held the inventory and Western demand set the clearing price. That world is gone. Shanghai commands a 24% premium because that's where the industrial demand is concentrated, and that's where export controls lock the metal inside the border. The premium isn't speculation. It's the cost of accessing supply in a market where availability is restricted by policy, not price. Here's the tactical adjustment. Accumulate physical silver at Western spot prices while Shanghai trades at a premium. You're buying at $104, while the physical reality in the world's largest consuming region is $130. That gap will close. Either Western prices rise to reflect scarcity, or Chinese demand collapses. Chinese demand isn't collapsing. The timeline for this adjustment is 12 to 24 months. That's how long it takes for physical supply constraints to force paper markets to reprice. During that window, Western prices will be volatile. Leverage will get flushed out. Weak hands will sell. But the fundamental supply deficit remains. Focus on allocated storage outside China's export control reach. Avoid rehypothecation. Avoid unallocated accounts where your metal is a liability on someone else's balance sheet. The jurisdictional risk is real. If export bans expand or capital controls tighten, you want physical possession or allocated storage in jurisdictions that respect property rights. Consider mining exposure as a diversification hedge. Latin American producers represent roughly 15% of potential global output with proper investment. Mexico, Peru, and Chile have existing infrastructure and geological deposits that can scale if prices justify development. These jurisdictions offer geographic diversification away from Chinese supply chains. The recycling angle becomes economically viable above $100 per ounce sustained pricing. Electronic waste recovery, old jewelry melting, and industrial scrap reclamation all pencil out when the spread between scrap value and refining cost justifies the processing. Higher prices unlock secondary supply, but that supply takes time to mobilize. The math is clear. China controls 60 to 70% of refined supply. They're restricting exports. They're consuming 20% of global production in solar manufacturing alone. Western inventories are depleted. The premium in Shanghai is telling you the metal is flowing east and staying there. Position accordingly. China has created a physical silver trap using export controls and solar demand as the mechanism. The $26 Shanghai premium over London isn't a temporary dislocation. It's a structural signal that Western pricing is lagging physical reality. The sovereign ratio adjustment is straightforward. Increase physical allocation, prioritize non-Chinese custody, add mining exposure for geographic diversification. The time frame is 12 to 24 months before Western prices must rise to reflect scarcity. The routing signal is clear. The metal is moving east. It's not coming back. Position now while Western prices lag Shanghai reality.